Hi, everybody. I'm Harry. I'm a sophomore from Chicago.
I'm Ben. I'm a junior from Wharton, and today we're going to be pitching a long for Transocean. So a little bit about the business. Transocean is an offshore oil rig contractor. They have 35 rigs, 27 of which are ultra deep water drill ships, and 8 of which are harsh environment semi-subs. Couple key differentiators that we identified: significant backlog, their fleet, and their leverage. So they have about $9 billion in revenue backlog, which is a lot more than their closest competitor with $4 billion. So it's good to see the steady cash flows. Looking at their fleet, we'll touch on this more later, but they have a lot of 7G plus and 8G ships, which are considered more advanced drillers, so that's good. And then they have about half of the cold stacks drill ship supply in the world. So as day rates go up, that's a significant advantage to have. And then lastly, looking at leverage, all 3 of their biggest competitors went bankrupt in the last couple of years, and they didn't. So they have about $6 billion still in debt, and the average for their competitors is about $0.3 billion. Taking a look at the competitive landscape, you can see that it's really consolidated from 10 big players to only 4 big players today, and at the same time, enterprise value has gone down from about 160 billion to 20 billion. And then looking at the different 4 main players, you can see Transocean is pretty differentiated with the 8G, 7G plus rigs, which are better rigs. So good to see that. And then also harsh environment semi-subs, they have 8, way more than their competitors, which is better semi-sub to have. And lastly, you can see they have a lot more cold stack ships. So like I said, if the day rate environment improves, then they have more ships that they can use to capitalize on that. Looking a little bit at the price history, since their competitors emerged from bankruptcy, they got quite a premium for rig, trading almost at 5 times EBITDA higher than their peers. But that's really come down. They're only trading about 2 times higher than their peers now. So we see that as a pretty attractive entry point.
And a few other comments about why we still think rig could be argued as cheap despite trading at an offshore premium. So multiples in mid cycles historically, there's been times when drill ship heavy fleets have traded at 3 to 4x premiums, and also there's been times when jackup heavy fleets have traded at similar premiums. Rig at times has traded up to 6x premiums historically. When supply and demand is right, it takes around like 5 years for a new one to get to the market. So the markets, when they think that a company has a really attractive fleet, they have a large premium. So while we think this 7x entry multiple is attractive, both relative to history of the COVID lows, but also we think there's still a lot of room for uplift because our theses are very idiosyncratic. So our thesis stands on 3 legs. First, we believe that there's going to be long-term and up to 2027 day rate bifurcation rewarding 7G plus ships to extend. Secondly, we believe that porous shipyard dynamics are going to heat up cold stacked assets, and we believe that these are undervalued by the market. And finally, we see a 2026 catalyst of 13 new drill ship contracts that are going to reprice into $3 billion maturity walls to create a power for pounds, ratings, and breaks equity, and we think this is a $10 stock. So for our first point, we're highly skeptical of consensus forecasts of day rates. Above is a Westwood 7G and 8G forecast. Usually they just use straight line growth rates. These forecasts have historically been very poor at predicting nuances. And for example, the jackup surge in 2028 was not captured by Westwood's forecast. Rystad and Wood Mackenzie do a similar thing. They pretty much hoard their data and sell them at costs. For one of our bachelor's theses, we had got this data at a discount and we use it to review Westwood's forecast. The street generally prices this in with our own diligence and equity research reports. We find generally that the street has been modeling around the 5 to 7% more aggressive day rate growth for rig and valve years, which also makes sense given they traded at premiums. We believe that the street is starting to price in our thesis here a little bit, but we think we're ahead of a long-term trend. Our context for a shipbroker conference is that brokers are starting to notice these trends, but our markup switching a Remax model, which we'll go to the next slide, sees asymmetric day rate increases into 2027. We believe that we have 16% of 4-year revenue growth delta that's not priced in by street. So our model uses ship data. The green line is called the supply tightness index, and I can go more into Q&A, but pretty much it indicates the amount of ships that are not operating and that could operate in the next 2 years. The yellow line is the demand index, which shows the amount of unsanctioned reserves at different depths and then matches them to each type of rig. We have 6 proprietary forecasts that we use that directly quantify our thesis at our revenue build. The red line is the forecasted day rate. We believe our model is state of the art and is more effective than any type of sell-side revenue build because our model trades on 5% mean average error on 4 years of historical data. The 2 main conclusions, you can sort of see it in this graph. On the Jacob graph, you have all of these rigs have super tight demand tightness, but supply tightness, but demand is not that far. Whereas for the bottom, they chase each other. So for thesis 2 on cold stacked assets, our research shows a 700K plus day rate is necessary. Shipyards are not business; they build ships, let supply reduces day rate, and then reduces IRR. The issue is that 700K day rates aren't even in our most bullish 7G forecast. We don't think the shipyard is going to go green in the next 10 years. Also, as Butch noted, offshore is at peak consolidation, and the open market for rig sales has been really weak as rigs sold through their lower spec rigs for only 150 million a piece because nobody wants to sell their high spec rigs. They would lose their edge. So next slide. We believe that the street underestimates this uplift. We believe 2 activations that are base case assumptions gets us to mid-cycle of 1.1x EV at PV. Presently, EV and PV lags us around 0.7. We believe that these assumptions get us back into a mid-cycle, which is where we're at offshore right now. There's a cutoff in the slide here, but we ran through the 3 assumptions into our revenue build, and there's a 0.25 cold stacked rig reactivations we estimate the street that's priced in by a forward revenue forecast. And we see this in the face of management, which is anticipating a 2025 reactivation and also have 2 fairly low spec rigs that reactivated in the past 2 years.
So moving on to our third thesis point, leverage risk overstated. So as I mentioned earlier, they have a little over $6 billion in net debt. And I think a lot of the market sees that as a significant bankruptcy risk. You can see that with almost 20% of the float is the short interest right now, so significant short interest. But we think with the increasing data Perry projected earlier, and the contracts that they already have in place going through 2028, they're going to be able to pay off a lot of that debt when it reaches maturity in 2027. At which point the bankruptcy risk will be a lot less, and you could also think they might toggle their discount rates a bit lower at that point because they have a lot less debt on hand. A little bit about our value. Sorry.
2 minutes.
A little bit more about our valuation. We tried to go rig by rig, look at the contract that they had, like I mentioned, going through 2028, and then looking at the idle time that might exist when a rig's not in use, when it's cold stacked. And then also looking at the operating costs to get it operational again. And just a quick note on that, those aren't projected as a percentage of revenue because revenue is going to be a lot more dependent on day rates versus operating costs. And then we ended up compiling all of those to get total revenue based on revenue per rig, taking out CapEx and net working capital, adding back depreciation and amortization, free cash flow, and then we use the mid-year convention to discount our cash flows. And then we toggle a couple different scenarios that Eric talked about.
Yeah, so the main assumptions here are that day rates get to Armageddon situations, a serious drop off by 2026 there. They get 1 degree lower mean square error in each case, and then they hit our model. In the bull case, we believe 1.5 cold stacked rig activations for forecast period. Will achieve a base case 3.5 in bull, 0 in base. Bear, they keep issuing more debt for a slower debt payoff. No extra issue debt in base bull. And this all is to achieve what we believe multiples could expand back to 2x 12 years, but 2022 premiums. As EBITDA grows into a 40% delta of the street and 2 rig activation parts them. And then we think the leveraging progresses faster than the street past 2026 analysts will also have normalized price flow and the rig activations for historically low EV. This should deliver around a $10 price target in our model over a full cycle of offshore because you obviously have the price in the down cycle.
So just a little bit about some of the risks.
Risk and mitigants for joy.
You could wrap it, give it like 30 seconds.
I may just handle this back real quick.
Yeah.
So the main short-term catalyst is that these sales of most spec rigs, stock sold off by almost $1 earlier this month. We believe that as the market prices in our bifurcation pieces, they'll see that these really are non-core assets and aren't that essential to the business. In catalyst two, we think continued demand from both Mexico, Norway, South America will sort of have this quarter by quarter catalyst chain to realize our thesis. And then as management targets your activations, we expect our first in 2025 and second or third over the next 2 years. And then finally, that Q4 catalyst is going to be huge for changing the ladders from oil to company.
Questions from the judges? Your training set goes back for 4 years of historical data. Can you walk us through the selection of 4 years of historical, just because 4 years puts us back in 20, which is maybe an unusual or what informed the decision to use 4 years of historical?
So that was one example of an upcycle in a TRO. We did do some other training sets on later dates and had pretty similar results. That number was just we thought 4 years was sort of a long enough time to see like how these rates respond for regressors. There wasn't really like a ton of reasoning, you know, with including 2020 or not. We've broken it up at other on other segments as well. And again,
Thank you.
This seems like kind of an option play, the option on what happens to oil here. And you mentioned using a $75 barrel price in general. How do you view that sort of your exposure to oil price fall? Is that where your markup thing comes in, or what exactly? How do you think about that?
I'll start.
Yeah, and our risks and mitigants, we just tried to keep it consistently at 75 going forwards. We thought that was pretty reasonable where it was based on where it was today.
Not just
yeah. As far as
high vol means like the real option value here of their.
Yeah. So the argument here is, I mean, these basins all can get achieved at 75. Obviously, some of them could get drilled at like 60 or 50. That's just going to reduce your upside as the price of oil looks out. I mean, if you are like a bear and see like $40 WTI over a forecast period, that's obviously going to push on the thesis by one. I mean, our view is like this is in line with several consensus forecasts. If you're not comfortable with that assumption,
I'm just saying it's not just the level; it's the vol of oil. It's the way up, and that's obviously going to be good for bringing these assets online.
Well, so we wouldn't have to price in any basins past 75. Basically, all the basins that are priced into the proprietary model we use are all at 75 bucks. So the downside, I guess, wouldn't be captured as well with this, but out of the upside, the assumption here is that it's just a full yield of 75. It's sorry for misunderstanding the question.
This industry is consolidated from 10 to 4. How how oligopolistic or how fierce is the competitive environment? And I guess 4 enough for more rational pricing to emerge, or is it still a pretty competitive commodity type pricing scheme?
I think it's still pretty competitive, but we see like Transocean is able to differentiate themselves from their competitors, having those like 8G and 7G plus rigs, and it's kind of cut off at the bottom, but just a bit more about like those rigs are significantly better at drilling, so they're able to differentiate even in this competitive environment.
To add to that too, what we've seen in the consolidation is that rigs have started to specialize in different kinds of drilling. Like Valaris has adopted passive jackup, whereas Transocean is sort of stuck with the segments that Butch has described. So pricing at the same time, it's competitive in the sense that like rebuild or resale costs are found more competitive as like these companies that want to share rigs with each other. But I mean, there really isn't a whole lot of competition for 70 bus or HE market just because nobody else has them. Similar end, like Polaris's harsh environment jackups provide similar kind of growth, but I think that everyone's trying to sort of flow in different markets within each genre.
I have, maybe there's a reason I do consumer, but I have a very basic question. These guys contract with the majors, right? So like how does the structure of the contract work? Like, is it a fixed price contract where the major pays them X amount of dollars?
I think for the most part, it's a fixed, like day rate,
Okay,
and the contracts could stretch out for a while, like some of those will go up to 2028.
so what's their concentration with the majors?
I think the biggest player was like Shell around like 15 or something.
Okay,
So Shell, Total Energia, Petrobras
Okay.
are the big ones that typically get these rigs, and those are the big like driller majors. Something to keep in mind about day rates too is that they are recorded daily on revenue. So
Yeah.
basically, a rig goes to water, drills, and then based on the functions of that day, they could report a different day rate too, based on how efficiently they drill. But these contracts are sort of agreements that it's a negotiation process between both the rig contractor and the major.
Okay.
As the major is trying to basically undercut the market.
Yeah.
But the offshore contractor obviously is also trying to increase the amount of rates they can get early on.
one last one, real quick, because we hit time. How easy is it for the majors to break the contract?
It's possible. It's been done. It's not been done really frequently at all for Transocean. I mean, one example was on the downside of Transocean. This is a really popular short end because I mean they had all this these cash flows from these backlogs, and majors sort of they had to pay them if a major if it was bankrupt or something.
Okay.
They won't. But I mean historically they've been pretty resilient in downcycles. So.
Any last questions from the judges, Zoom or in person? We were pitching this to a generalist PM. And the PM said, is this just a bet on oil? How would you kind of most succinctly respond to that pushback?
I mean, to some degree, it's about $75 WTI. Like, there still is upside priced in at $60 or $50, but obviously, are like attractive 120% upside that we present here wouldn't be possible. But at the same time, we're sort of more thinking about how the market's pricing these in general, relative to general, relative to the gold stack market, relative to the 7G, 8G market. And there's a lot of nuances in those markets that we're trying to capture.
I think that's